Welcome to our podcast on financial reporting. Today, we are diving into Indian AS 40 investment property. This is an important standard that helps companies classify and account for real estate held for investment purposes. Joining me are my fellow hosts, myself Marina Toji, Amal Tomi, Adulya, Janita, Freddy, Bibin, Alentom, and Adarsh. Let's start with the basics. Amal, can you explain what Indian AS 40 covers?
Sure. Ind AS 40 applies to properties held to earn rentals or for capital appreciation, rather than for use in production, supply of goods, or administrative purposes. It mainly includes land or buildings that companies hold as investments. Unlike owner occupied properties, investment properties are accounted for differently.
Great explanation. Adulya, how should investment properties be accounted for initially?
At initial recognition, an investment property is recorded at cost, which includes purchase price, transaction cost, and any directly attributable expenses like legal fees. If a company constructs an investment property, all related costs during construction are also included.
Okay, that's right now. Janita, can you tell us about the measurement model after initial recognition?
Sure. After initial recognition, companies can either use the cost model or the fair value model. Cost model, the property is carried at cost less accumulated depreciation and impairment. Fair value model, the property is carried at fair value with changes recognized in the profit and loss account. However, in India, companies mostly follow the cost model and the fair value is disclosed in the notes to accounts.
Interesting. To better understand Indian AS 40, let's discuss a real life case study. Freddy, what case study do we have today?
Let's take the case of Infosys Limited. Infosys, a major IT company, holds several properties. Some are used for business operations, while others are held for rental income or future appreciation. These investment properties are classified under Ind AS 40 and accounted for using the cost model, with the fair value disclosed separately in financial statements.
That's a great example. Bibin, can you share a practical scenario where Indian AS 40 is applied?
Sure. Imagine a company APC Limited that owns two buildings. Building A used as their corporate office, Building B rented out for income. Building A is classified as property, plant and equipment under Ind AS 16, while Building B is an investment property under Ind AS 40. This classification impacts depreciation, disclosure and fair value reporting.
That's a clear distinction. Alentom, what challenges do companies face with Indian AS 40?
One major challenge is distinguishing between owner occupied and investment property, especially if a part of the building is used for business and another part is rented out. Another issue is determining the fair value. As real estate prices fluctuate, also companies using the cost model must still disclose fair values, which requires expert valuation.
Good points. Finally, Adarsh, can you tell us why Indian AS 40 is important for investors?
Of course, Ind AS 40 ensures transparency and comparability in financial reporting. Investors rely on fair value disclosures to assess the potential return from a company's real estate investments. It also helps in making informed decisions about the company's financial health and profitability.
Okay, that wraps up our discussion on Indian AS 40 investment property. We explored its key concepts, case studies, real world applications, and challenges. Thank you, team, and thank you to your listeners for tuning in.